Well, g'day there, traders right around the world. Thanks for joining me in this special weekend update. What I'm going to do for you is provide you with some comprehensive overlook for the three US market. So what we'll do is we'll take a look at the Dow Jones Industrial Average. We'll then transition into the S&P 500 and finish with the NASDAQ. We'll come to some form of conclusion as to which direction this market looks to be moving as we transition into trading beginning Monday, the 14th of April 2014. So what we'll do, we'll begin here. I've just got a daily chart of the Dow Jones Industrial Average that you're looking at right now. And as you can see, really Thursday's and Friday's trading session have been quite bearish. Now, we've been remaining very neutral on all three of the US indices. As you can see on the Dow Jones, for instance, we've had this bracket trade or a bidirectional trade set up at or above 16,665 for a bullish breakout if in fact we were to break out above old resistance levels. And we also have this bearish trade setup which has been in effect really since the beginning of March to say that, hey, we're going to be looking at this market with a bearish perspective if in fact we break below 16,015 or 14 points on the overall market indexing. Now, what we've concluded with as of Friday's trading session is a very, very close call to our bearish trigger. As you can see here, we've closed just above this trigger, so it would not surprise me if we come into trading on Monday and we continue with this bearish sell-off. Now, there's a few ways that we can analyze this. We can say that we've been moving into resistance once, twice, three times. We had a little bit of a false bullish breakout to the upside, and now we're really starting to fail below, as I said, this bearish trigger which we've had set up since March. Also, we have what we call a double top potentially, or at least a little bit of a funky head and shoulders, or if not, just a resistance level which has been rejected three times. So again, once we close below the neckline is essential. We should have a very bearish perspective on the overall market. Now, this again transitions also through to the S&P 500 and also the NASDAQ. These are a little bit more defined and progressed in the bearish move. We are right here on what we call a very significant pivot point. And again, if we get any bearish movement below this trigger with great conviction, we can say that the lower targets that we're looking at are down here about 15,700, and then again down here about 15,430. They're the two immediate targets. What you really need to pay attention to anyway is on the weekly or even on a daily, if you bring up what we call the primary trend line, which has been in effect since the lows made in 2009 after the GFC, you can see that we've been making a series of higher highs and higher lows. Now, as you can see, this is what we call a trend line. This is just showing us the velocity or the angle of the bullish trend, and this is soon going to come into effect with current price. So I'm zooming in on the detail. All I've done is just extended this red line out into the distant future, and you can see that we're meeting it around here in the year of 2014 at least. Now, we are in what we call a little bit of an intermediate correction. Now, the primary trend is bullish, but the intermediate correction is about to take place, and it looks to be taking place down into this level which I just mentioned, around 15,400, or at least into this rising bullish trend line. This is where I expect the market to slow down, and a really, really great, let me just undo that tool, really great target down here. As you can see, the last 2 weeks candlesticks have been incredibly bearish. We have a shooting star candlestick up here at resistance. We also have what we call a bearish engulfing pattern, where we've engulfed the previous week's entire candlestick body, or it can also be classified as a one black crow. Either or, they're one of two of the most bearish candlesticks or early reversal candlesticks that we have in the world of technical trading. And as you can see, we have what we call a hammer candlestick dating back to the beginning of 2014, and that's really going to coincide with this support level down here, this rising bullish trend line, and all in all, this lower wick down here is telling us that there's buying pressure around these lower levels. Much like this individual candlestick right here, it was the impetus to move the market higher. So what we're starting to see is the breakdown of the Dow Jones Industrial Average. We're right on the edge of a knife. If we move any lower, all right, it'd be great opportunity to be looking at put options on the overall ETF, or at least looking into put options on the Qs or the actual SPY if we take a look at the S&P 500. Now, again, as I just alluded to, I said that the Dow Jones Industrial Average is a little bit more sort of trailing, or at least lagging the S&P and also the NASDAQ. So as you can see, we've had these two bidirectional triggers set up for the better part of 2 months now, and we're only just starting to break down below our bearish trigger here at 1,828 points. As you can see, it's a quick trip down to our next target, which is down here about 1,800 more or less. But really the ultimate targets that we're looking at on the S&P 500 is this 1,777 level, and also this 1,745 level down here. So we've got 1, we have 2, and we have 3. The way it'll play out is we're going to see some short-term buying around these support levels. It could set up in the way of pennants. It could set up in the way of bear flags when we break down like this. and also in the way of stair-step patterns. But what I do believe is going to happen is that we're going to come down and at least, at very minimum, come down and tag this 200 simple moving average. Generally what happens is if we sell off below the 100, okay, now these aren't good examples, but you can see that it's generally a good turning point at the 100, and that's where we're trading at right at the moment. But if we do not hold this 100, the next logical target is this rising 200. Let me go back in time and show you an example of this in effect. If we go all the way back to November 2012, you can see we fail this 100 and we trade right into this 200 simple moving average. Again, we fail the 100, trade into that 200. Let me go back again to show you exactly what I'm talking about. We fail the 100, we trade into the 200. So that's exactly what we expect it to do. It's not going to happen overnight, but it will transition over the month of April and at least moving into May 2014. All right, if I take a look at the NASDAQ as well, you can see again, bidirectional trigger, 4,394 on the bullish side, 4,068 on the bearish side. It didn't really bother me which direction the market wants to move or wanted to move. We remain absolutely neutral, okay? And then we trade, of course, the ensuing breakout or breakdown. Now, again, we are quite a ways into this bearish move. You can see it's really been setting up since March 2014. We've really been establishing those lower highs and also those lower lows, and we are getting very close to this ultimate swing low over here established in January and February. We've broken that 100, broken support, and this 200 rising simple moving average is also going to mark the spot with a support level and a swing low level or swing intermediate low, which has been really set up since November 2013. It's acted as resistance in October and November. It's acted as support in December, support in February, and we're very, very close again to touching this price point again in the month of April 2014. So although the markets as a whole look incredibly bearish, especially the Dow Jones Industrial Average, the S&P, you need to have a good understanding of where your targets are, and of course to exit your positions once you hit those targets. What I mean by that is, do not be greedy, exit your positions or exit your overall ETF trades depending on how you set your trades up in your own trading accounts. Of course, that is your own decision. But for the most part, we are bearish moving into the week beginning the 14th, which is Monday, and probably throughout the month of April anyway, at least as we transition into earnings season. Now again, that's going to throw us a bit of a spanner into the works for a lot of our top 10 shares, but it shouldn't really play too much of an importance into shares outside of our top 10 individual or top 12 individual trade list, which we look at over the weekend in Pivot Point Pro. So that's a really good market update. Again, be careful traders, do not place too much, or do not, invest too much of your trading account into positions which aren't completely set up. What's actually happened is that the move has already began, and as long as that risk reward ratio is justified at least above a 2-to-1, then you can take the trade. But if you're sort of catching trades or trying to force trades, I'd strongly advise you not to do so, because again, these markets can whipsaw very quickly, and again, if your risk reward ratio is out of sync or out of balance, then it can cause you a few troubles leading into the future as a technical trader. So if you want to learn how to do this for yourself, have a look at Pivot Point-Trading, sign up for a free scholarship. You'll get access to 8 classes. Our entire level 1 lesson is a scholarship initiative given away, and it'll transition you anyway, or to get you beginning on the journey to becoming an autonomous and profitable trader. So all the best, everyone. Thanks for watching this weekend edition market update. Stay tuned anyway. Subscribe to our channel, and we'll provide you with again additional information as the week progresses. All the best. Goodbye.